And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Wednesday, it's hump day. Normally, Danny Ratliff joins me, but not today. It's just you and us today, just you and me. We're just going to hang out today, talk about a few things. Catch up on a few kind of things that are moving the markets. Interestingly, yesterday was kind of a very interesting day. And again, there was a lot of movement yesterday, and we'll talk some more about the market here technically when we get into the before the bell kind of update. But a lot of focus yesterday on the JOLTS report, which showed an increase in jobs openings. But really, when you dug down into the internal of that report yesterday, it really wasn't very good. The big reason for the increase in the number of job openings was because of vacancies in the professional and business services sector. So in other words, you have more job openings simply because they're just vacant openings at this point and they're not filling them. So it's quite interesting. While the JOLTS report was initially kind of received as, oh my gosh, the Fed's going to have to not cut rates here because the economy is just doing way too much. Actually, that wasn't the case with the data. One thing we're going to see here on Friday in particular, this will kind of be our first bit of test, so to speak, will be the employment report. So on Friday, we'll see the employment report for December. And the question is going to be really at that point, are we still seeing that type of employment growth that we've been seeing over the last year? Because again, when we come up into March, as we touched on a little bit, I think yesterday, expecting some pretty big negative revisions to the 2024 employment data. In other words, the employment wasn't nearly as strong as reported in 2024. So, we'll see how all this plays out, but economic growth is really kind of the key issue here. Now, having said that, it's not bad growth at the moment. The Atlanta Fed right now currently predicting that Q4 GDP will be 2.7%. Now, let me tell you what that means real quick if you don't know. So 2.7% is inflation-adjusted growth at an annual rate. So if you really want to know what the growth rate is when that's reported, right? So they say, okay, and we'll make math easy for you this morning. Let's just say that they say, well, growth is going to be 2% in the fourth quarter. Well, take 2%, divide it by 4 because it's quarterly. And so your growth rate for December would be 0.5% growth. So the economy grew by 0.5% in December, or in the fourth quarter, sorry. That 0.5% is then reported at an annual rate. So if you just looked at December and the fourth quarter and said, okay, it grew at 0.5%. So that means that if we annualize that, the economy grew at 2%. So what those numbers are telling you is that in the fourth quarter of this last year, the Atlanta Fed's expecting that the economy grew at 2.7 for the entire year going forward. In other words, we're just going to take that number and assume that's the same every quarter going forward for the next year. This is a problem that exists with a lot of the data that you see. And you have to understand this data that comes in. You have to really look at the data and say, okay, what's it really telling me? Because, again, we annualize a lot of this data. Here's another good example of this, new home sales. When we have new home sales, they'll report like, oh, we sold 130,000 homes. No, we didn't. You have to take that number, divide it by 12, because they report it at an annual rate. They assume that we sold 1,000 homes, or sorry, 1,000 homes in January, and so we're going to do 1,000 homes every month for the year. So we sold 120,000 homes, right? That doesn't really tell you. We only sold 1,000 homes. That's what we sold. We didn't sell 120,000, right? So this is the thing that we have to really understand about the data. Again, the markets respond to the data as it comes in. Typically, a lot of knee-jerk reactions. We definitely saw that yesterday, and we're going to talk about that in just a moment. But again, you have to really understand the data and what you're reading, and then, of course, how that impacts the very factors that drive equity prices. So again, what drives equity prices at the end of the day? It's earnings. At the end of the day, all said and done, it's earnings. Are earnings increasing or decreasing? That's what drives equity prices. And again, so all these factors that we look at come back down to impact, is the economy growing? Because that's where earnings come from. So those things to really kind of pay attention to. Okay, so now let's talk about what happened in the markets yesterday. So first of all, today is the 5th trading day of January. Now, why is that important? So goes the first 5 days of the year, so goes the month, so goes the month, so goes the year. We are in the middle of the January Barometer. So today, if the market closes higher, we will have successfully created a positive first 5 days of the year. Just barely. Just barely. This morning, futures are pointing slightly lower. So again, we are right on the cusp of failing the first 5 days of the year. So we failed the Santa Claus rally. We are threatening, if we close lower today, which is kind of what we're threatening here early in the morning, the Dow's down about 18 points right now, so that could turn around really quick. But again, markets are looking to open lower this morning. So if we close lower today and take out the low from the first trading day of January, that is going to basically trigger that second aspect of the January Barometer. So if January ends negatively, so if the first 5 days are negative, the month tends to be negative. If the month is negative, that portends to a negative year, using averages, looking back over history. Now, 2024, we had a negative first 5 days and a negative January and had a whopper year. So again, it doesn't always mean a bad outlook, but it certainly has been a rough start so far to the markets. And again, this is, kind of where we are. So yesterday I talked about yesterday morning that we had gotten above the 50-day moving average. We were challenging the 20-day moving average. If we could get above that, then we had a clear path for the market to move higher. That didn't happen. We opened higher right at the 20-day moving average and failed miserably yesterday. And yesterday's action really did not resonate with what was going on really kind of in the JOLTS survey. There was something else going on yesterday because everything got sold off yesterday. Stocks sold off hard, bonds sold off hard. It was really kind of a day of no safe asset really across the board. And we saw everything getting sold. And this looked a whole lot more like major institutional selling, hedge funds, shorting markets, etc. But there was something else going on really in the markets yesterday. Is it a one-day anomaly? Don't know. But there was something happening yesterday that was really not just a reaction to the JOLTS report. Because again, just a very quick look at the JOLTS report told you that it wasn't that important. Yes, the ISM services survey showed an uptick in prices. It was a minor uptick in prices. It wasn't a major inflationary push in prices. And again, that's a survey. And a lot of the survey managers right now have already talked about they're worried about tariffs. So again, a lot of buying, trying to get inventory in before tariffs start. Well, if there's a lot of demand to front-run tariffs, you're going to push prices up. And so if that's where that uptick in prices came from, it's temporary. So again, this data doesn't really pretend to the size and the magnitude of the entire market liquidation yesterday. So again, a very, very strong liquidation day yesterday. Importantly, we're sitting right here at the bottom of this consolidating trend. So again, the market needs to turn around. We are very close. If we take out this low, that's going to violate that first 5 days of January. So we are right at the bottom of that trend. The market needs to find support here and turn back up if we're going to keep that first 5 days of January positive. Again, that kind of gives the market a little bit of bias for the month. We'll see what happens today. We'll report back to you tomorrow on that and kind of what to do next. But that's what you need to know before the bell this morning. We'll come back. Got a lot of stuff to get into this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. realinvestmentadvice.com. Register today.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. By the way, we are quickly selling out of tickets for the upcoming summit it's not this coming Saturday, it's the next Saturday, so a week from Saturday. So if you'd like to come, we'd love to have you. We're going to spend a lot of time. We've set aside about an hour just to visit with you personally, just kind of one-on-one, hang out, answer questions, because, again, we do some really in-depth, very high-level presentations, talking about markets, economy, fixed income, the whole nine yards. So we're going to cover everything at that summit, going through that, but also spend a lot of time just answering your questions. We'll have a live panel Q&A, but then we'll also spend time just having kind of a mix and mingle during a lunch. So I'd love to have you come. Tickets are available. Simply go to our website, realinvestmentadvice.com. Just click on the link at the top. It's an Eventbrite page, so you just basically buy your ticket and come visit us. So we'd love to see you. Okay, so markets. Again, we've got a lot of turmoil here really over the last couple of weeks with the markets, and there's a lot of kind of moving parts here. Again, we had a really great year last year on top of a really great year the previous year. We talked a little bit yesterday about some of the reasons why to kind of curb your enthusiasm, and that article is on the website. But, taking a look at kind of where the markets are, it's interesting because we're getting the markets in a bit more oversold condition on a relative basis, right? So if you've ever explored our SimpleVisor website, which is kind of our data research platform that we've built for you, one of the things you can do is go under the do-it-yourself research tab, which is kind of where we post just a lot of our analytical research. And one of the things that you can do there is look at relative performance. And so this is what this graph is showing you right here, which is this is the relative performance of the sectors of the markets relative to the S&P. So in other words, how are staples and basic materials and real estate and technology, et cetera, performing relative to, in terms of performance, of the overall market, right? So what's interesting to note here is that most of these sectors have moved down into fairly decent kind of oversold levels. And this is, even communications, which is, it's basically Google and what's my other big community? Meta. Missed that for a second. Have moved down. They're still overbought a little bit or outperforming a little bit right now relative to the S&P 500, but we're starting to move some of these into more underperforming levels of the markets. Now, why is this important? Well, these things tend to migrate back and forth between outperforming and underperforming over time. And so when things begin underperforming for a period of time, those things tend to become tend to become opportunities for relative outperformance in the future. And so some of the things to kind of be looking at is what opportunities are kind of presenting themselves. And one of the things that we're seeing right now, and to a large degree, are companies like Basic Materials, Industrials, which have been underperforming fairly handily lately. And if the economy is going to continue to grow, and we're going to continue to have some relative strength in the economy. Again, now I'm not talking about booming economic activity, but just some. In other words, we're not in a recession. These stocks are more economically sensitive, so they should typically tend to perform better. So, just for instance, let's just take a look at Basic Materials as an example, since this is one of the areas that were kind of more oversold. We see kind of the same thing. All the stocks that make up the top 10 holdings of the basic material sector are extremely oversold, right? So they're now pushed down into an area where there typically tends to be an opportunity. So, these are the things that we're starting to kind of look at. It's like, okay, where does the market rotate to next? If, and this is the kind of the big if right now, there's a lot of talk about, technology can't keep winning, and we're going to have this big rotation into small caps and mid caps as an example. Well, some of these stocks that have been really beaten down as of late, and again, it doesn't mean go buy them today, right? That's not what this means. It just means you should start to see some relative pickup in some of these areas of the markets that have been under a lot of pressures lately. Because just remember, everything kind of moves from overbought to oversold and from oversold back to overbought. It's just how markets work over time. Because markets are all looking for that next kind of rotational trade, that next opportunity. So when things get really kind of out of favor, they tend to become in favor later. They don't tend to stay out of favor for long. This is why markets move up and down over time. Let's say, and here we can kind of shift this just real quick and take a look at some factors related to the market. So the difference between the sectors of the market are like basic materials, industrials, communications. Factors are things like small cap, mid cap, large cap, international, emerging markets, etc. So if we start taking a look at factors, we kind of start to see some of the same kind of makeup of the markets. We're starting to see some of those factors in the markets moving back down into underperforming the S&P. So as a good example, momentum, which we use the ETF MTUM to represent that sector. The momentum factor is basically getting right on line in terms of performance. So it's not outperforming the S&P. In fact, it's slightly underperforming the S&P. Emerging markets, international, those have been drastically underperforming for a while now. But, if we take a look at, for instance, some of the biggest kind of relative underperformers, so we can look at this in both relative and absolute performance. So we provide both calculations for you. So absolute is, how is the factor performing relative to itself, right? Is it overbought or oversold on multiple levels, right? So that's absolute. So absolute performance. Relative is, how is it performing relative to the benchmark index, the S&P 500? Is it outperforming or underperforming? So, for instance, S&P 500 value has been underperforming, and it's been underperforming now for a while. If we take a look at just value by itself over the last, kind of 7, 8, 9, 10 weeks, it's just remained underperforming now for a while. So, value's been a real kind of drag in portfolios, even though fundamentally we should be value investors, correct? So again, and again, this is, kind of the issue. Small cap value, which is kind of one of the big hopes, right? It had a brief moment of outperformance, and it's basically collapsed as of late. And so again, we can kind of see that rotation is that, there for a moment right after President Trump was elected, there was a lot of exuberance about small cap stocks that's just completely fallen apart here over the last few weeks. So the question is why? If the whole thesis was small caps are going to outperform because we're going to have deregulation and tax cuts and all these type of things, then why did it just all fall apart recently? Right? What's changed? Are we now not going to have deregulation and we're not going to have tax cuts? Because that, as far as I know, that hasn't changed. So why all of a sudden are we having this massive underperformance in the very set of stocks that were outperforming based on the assumption that we were going to have all of these regulatory changes? And this has been the problem with the market as of late, which is the theses, right, that we talk about, or I should say the theses that the media talks about, keep changing. And if we look at, kind of the stocks that have been outperforming over the last 9 weeks, we take a look at, say, the mega cap growth stocks, which is represented by MGK. That's the mega cap growth ETF. And again, it's just stayed in overbought territory, right, on a relative performance. It's just stayed up there. So, it was supposed to be small cap, mid caps taking the lead, and the mega caps are going to underperform, but the mega caps continue to outperform versus everything else for the most part. So this is the challenge that we currently face in the markets, which is trying to figure out where money's going to next, because as of late, it's just been all over the place. We have, again, a good example is just this past week, right? Day before yesterday, NVIDIA hits all-time highs because of the release of new chips and GPUs and processors, and comments by the CEO of NVIDIA that got everybody all excited. Yesterday, the stock's down 6%. What changed in one day? Right? This is what makes it very hard to invest in the market that we're in right now, because all these narratives keep changing. And the narratives that were supposed to happen haven't happened, and the narratives that did happen weren't the ones people were expecting. And so this becomes the real challenge that, as investors, we just have to keep kind of working on and trying to figure out. And again, this is why, we spend so much time just talking kind of about the day-to-day changes, about this is what the market did today, this is what the market did yesterday. We're long-term investors, right? We want to buy things and hold them longer term, but we have to navigate these short-term variabilities and trying to figure out, well, is this just a short-term volatility event in the markets, or is this a sea change into a bigger event this year? And we'll talk about Dan Niles when we come back from the break. He's saying 20% correction this year.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I think you're really right on that, Lance, and I don't say that often, but
you better be glad we still broadcast on radio. When we come to YouTube, I'm going to tell you what I really think about your comments.
The Real Investment Show podcast.
I know I've got this little safety net right now.
Same show, your schedule.
Can't cuss me out.
Exactly. If we ever go to straight YouTube, man, it's going to be bad.
At realinvestmentadvice.com.
This is going to be an R-rated episode of the Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, a couple of things that kind of were making headlines yesterday. Dan Niles, who is a very well-known portfolio manager, coming out yesterday talking about that he expects, roughly a 20% correction this year. And that is not outside the realm of possibility at all. At all, right? In any given year, markets have a 5 to 10% correction. You have 5% corrections virtually every year. 10% corrections happen about every 2 years. So and last year's a good example. We had, 2 or 3 5% corrections last year and an 8.5% correction. The year before that, we had 2 or 3 5% corrections and a 10% correction. So, this volatility in markets, certainly something you should expect. Now, when you start talking about a 20% correction, that's a bit more painful, right? We haven't seen that since 2022. And again, while most people don't remember it's like, there was a correction in 2022. Yeah, the markets were down about 20%. And we forget that because of FOMO, right? And we talked about psychology here on the show, just, actually over the last couple of days, that, we tend to forget those events. And we tend to forget that we have these corrections that come along the way, and they're painful during the process. But then when markets go back to being good boys and girls, then we're all happy, right? And we forget about that. And so it happens. But a 20% correction is absolutely possible this year. And for a variety of reasons. One, equity risk premiums are at the lowest level we've seen in decades. We haven't seen equity risk premiums this low in a very, very long time. And at the same time, we have higher bond yields, right? So we have bond yields 10-year Treasury running about 4.8. So here's the question you have to ask. I'm getting a zero yield effectively on stocks. Right? I'm not being paid. What that means is that you're taking a lot of risk that you're not getting paid for. You have no earnings yield on stocks. So you're taking a lot of risk for capital appreciation. At the same time, I could buy a 10-year Treasury and get 4.8% return, guaranteed. So just from a fundamental perspective, investors should be choosing bonds over stocks right now because they're not getting paid for the risk. But again, that's the psychological side of the markets right now. It's like, oh my gosh, I want to own stocks because they're going up. And again, you'll remember a couple of years ago, everybody was jumping into the T-bill and chill thing, right? I'm going to buy T-bills. I'm just going to chill out here. I'm going to get 5% on my T-bills. It's great. And then the markets went up 20% 2 years in a row. So all of a sudden, being T-bills and chill wasn't such a good idea. Right? That and now, see, the markets are trained psychologically for that. Is that, the markets are just going to go up this year. We've had 20% years. We're going to have another one this year. What if you don't? Right? That's the risk. And again, you don't need a big event. And when you start talking about a 20% correction, it's like, oh my gosh, that sounds huge. It's not. Bring up this chart for me. So this is just a chart of the S&P going back a couple of years. And, what we have right now is that markets are getting pretty oversold here on a momentum basis. You've got, declining relative strength. And so probably you're not going to get a 20% correction from here. You're probably going to have a rally first before you get a correction. But let's just assume that the markets rally all the way back to 6,000. I need a round number. It's too early in the morning, and I've had less than 1 cup of coffee so far. So I need easy math this early in the morning to do a 20% calculation for you. Don't move that chart right there. That's a good spot to be in. 20% from 6,000 is, quick math, 1,200 points. Okay, 6,000 minus 1,200. Brent, correct me, check me on my math. 4,800. All right, so he's nodding. So apparently I've done good. I passed my math class this morning. 4,800 on the S&P. Wow, from 6,000. Sounds terrible. It takes you all the way back to April of last year. This is the problem with the markets. We have exaggerated the market so much over the last couple of years. We're up more than 40% in the last 2 years and more than 50% from the October 2022 lows. Is that a 20% correction only gets you back to where you were last year? It just doesn't move the needle to a huge degree, but 20% is going to feel terrible. Now we're going to try to avoid that if it's going to happen, right? We're going to try to reduce risk, hedge, those type of things. But again, I want to put this into perspective for you. A 20% correction just puts you back into April of last year. It's just that's how far we've moved markets. We're very deviated from long-term means. I showed you the chart yesterday on a quarterly basis about being, having deviations above long-term quarterly trends that we don't rarely see unless we're near a market peak. And again, as we talked about yesterday on that chart I showed you yesterday, is that the last time, in that chart, by the way, if you didn't hear the show yesterday, we were going through reasons to be cautious. One of those is the technical setup. And so if you go to our website, realinvestmentadvice.com, and click on the article "Curb Your Enthusiasm," the chart is in there, and it's the last chart in the article showing you the long-term measures of the markets. The last time we posted that chart and wrote about it was in September of 2020. I gotta get my years right. September of 2021, right? Just before we had the correction in 2022, which was about 20%. So I just want to put this in. The point is that, again, when somebody comes out and says, Dan Niles, famous portfolio manager, right, says expected 20% correction this year, entirely possible. He's absolutely right. The first reaction for people, and I got the reason I know about this article is because I must have gotten 50 emails on it yesterday. Did you see what Dan Niles said? Yes, I saw what Dan Niles said 50 times. That's very possible. We talk about corrections all the time. Corrections are a normal market process. And when they are extremely overbought and extremely extended, corrections happen. That does not mean go sell everything and go to cash, right? That's where we make our mistakes because we don't know when to get back in, right? Dan Niles said there's going to be a crash 20% this year. I don't want to be involved in it. I get it. I don't want to be involved in it either. But in theory, right? In theory, well, here, let's not even do it in theory, right? Let's talk about this in reality. Let's say that in April of last year, I said markets are going to crash by 20%. I don't know when, but they're going to crash by 20%. I think within the next, year. And let's say the market crashes 20%, or I shouldn't say crash, that's not even a correct word, corrects 20% in April of this year. You only back to where you were in April of last year when I said the market was going to crash of last year, and then sat there and then just did nothing for a year. You've missed out on all that return in the markets. And yes, the market crashed. You're like, okay, well, I can get back in, but you won't. See, because psychologically, when the market's down 20%, you're like, well, see, there, it's going to keep going now. And I'm not going to get back in. And this is the psychological trap that we get ourselves into, right? So yes, the market is, I would certainly expect 5% correction this year, a 10% correction this year, highly likely. And just, even recently I was talking about, hey, this market crashed 20% this summer and then rally into the end of the year and basically have a year where we crank out maybe a total return for the year of something like 5-6%. That wouldn't be surprising at all after 2% up years, or so 2 years up 20%. We've talked about just expect more volatility this year, and look, I agree with Dan Niles. I think he's right. I don't know for sure how large a correction would be this summer when it occurs, if it occurs. And that's a big if. I mean, it's too hard to predict that far out. But if or when it occurs, is it 10? Is it 15? Is it 20? What is it? Don't know, right? We don't know. We'll reduce risk. We'll see it coming, right? We'll start to see the early indicators of that process occurring. We'll start talking about reducing risk, rebalancing portfolios, doing those type of things to avoid as much of that drag as possible. And then we'll have to figure it out, kind of from there, what we do next. But, the important thing is not to overreact to those types of headlines, because that's what gets us in trouble psychologically. Yes, we do a good job of getting out. We do a terrible job of getting back in. And we've just seen, just review your own behaviors, right? And again, if you're really good at timing the markets and you get in on time and you get out on time, you do it, great, keep doing what you're doing, man. I probably got a job for you. But if we really honestly review our own behaviors and what we do well and what we don't do well, I think we'll figure out that we don't navigate corrections very well as individuals. Me either. And that's why, it's important just to not let emotions kind of rule your processes. And this is why it's very important to have a process. In fact, let's talk about that when we come back from the break. We'll talk about the reasons to have a process and how to build a process that will work for you. Don't go away. We'll talk about that next right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
So, investing. The biggest mistake that most people make, and includes me, right? So everything I'm talking about with you right now is personal experience. And, we all learn through the school of hard knocks over time, and we never stop learning from that, right? We will always make mistakes in investing. We will always make bad decisions. Decisions that we do make won't work out the way that we think they will. And then how we react to those decisions become another issue. Good example. Just recently had an exchange of emails with an individual. And they had sold all their stocks previously, gotten into bonds, 100% bonds, because they were losing too much money in stocks in 2022. So make the obvious switch. I'm going to go into bonds because bonds give me protection, right? So yields have gone up, so the bond prices have gone down. Now forget the fact that bonds are going to mature at face value, right? We're not talking about that. If I just hold the bonds, I get all my money back plus my interest payments, and I have a very calculable rate of return. But emotionally, we get tied up into now I'm losing. I was losing money in stocks, so I sold everything. Now I'm invested fully in bonds, and I'm losing money there. I need, what do I do now, right? So we get ourselves kind of trapped in these positions. And this is what happens when you don't have an investment process, right? And your investment process can't be just mentally. It's got to be written down. You've got to have a written policy that you keep it on your desk, right? That you can refer to. I've got a list of rules that I keep on my desk, and we have an investment policy statement that is written, sitting on my desk. And so when I get myself in, when my emotions start to arise and I start feeling pressure to do something, right? I go back to my rules and I reread my rules, because it's the emotional biases that get us into trouble, right? When things aren't working a certain direction the way we think they were or should or would or could, then all of a sudden we start kind of panicking. And this is when we make bad investment decisions and we sell at the bottom, we buy at tops, we do exactly all the things we shouldn't do. So importantly, and I've got a list of New Year's resolutions coming out on the website, I think on Friday. I've got rules about portfolio management coming out the week after that. It's every January I have a couple of articles that I produce that are just kind of your setup for the year, right? Just trying to get you in a good place. So those will be coming out over the next couple of weeks. We'll talk about them here on the show. But you need to have your rules written down and make sure that you don't violate your rules, because when you start taking an action, and if you look over at your desk and go, wow, if I do this, I'm violating that rule, then you probably shouldn't do it. And, look, markets are going down, you can sell short. Problem is, for a lot of people, they sell short, they don't know when to close out their short. So then they wind up losing money on the short. They're a long-only investor. Markets go down, they start panic selling their longs when they should be buying their longs, right? All the things that we do wrong. So again, have a set of rules written down. However you generate them, whatever and look, everybody manages money differently. And if you can't write down a list of rules, then I would probably go hire somebody to manage my money for me. Because if you can't even come up with a set of rules to manage, you really should. It's like driving without understanding how to drive. So if you can't even come up with a list of basic 10 rules, if you can't write down 10 rules and put them on your desk of things that you should and should not do to manage your own money, then don't manage your own money, because you're kind of flying blind. And it's a good test for yourself, right? It's just a really good test to see really if you understand what you're doing. And if you don't, hire somebody else to do it for you that can. And ask them, what are your rules? Let me see them, right? They should be able to produce them. Because any good manager will tell you, they do, you go talk to any good professional manager, they have a written investment policy statement. They have their investment rules. They track their trades. Every trade they make, they have them written down somewhere. They say, I bought this, I sold it here, this was the result, right? So that's just kind of a good primer for finding somebody to manage your money. And look, things go wrong, right? Things happen that because markets on a short-term basis do things that have nothing to do with the long-term fundamental drivers. And look, long-term fundamentals matter. So don't get me wrong. We talk a lot here on the show about short-term movements. But fundamentals matter, and they matter a lot in the long term. Earnings growth, valuations, economic growth, those things matter very much to the long-term returns of markets. Just not over a 3-month or 6-month period. So if bond yields do something because of an economic report today, that doesn't change the dynamic of what drives bond yields long term. If stocks go down sharply today because of some report, that doesn't change the long-term driver if earnings are growing. Now, if earnings aren't growing, that's a different story. If the fundamental drivers that back interest rates changes, that's a different story. And so when those things change, then yes, you need to change your theses, et cetera, and then make your decisions from there. But one of the mistakes that are actually, I'd say probably the biggest mistake that all investors make is they allow short-term movements in the markets to impact their long-term investment decisions. And that happens because you don't have a policy statement written down that you can refer to and say, okay, my emotions are getting to me. Let me go back to my policy statement. What is it that I'm trying to achieve? What is it I'm trying to do? And that policy statement should contain a few things. It should contain, how do you come to your investment decision? If I'm going to buy a company, a stock, right? How do I come to the decision of buying the stock? Did I buy it just because it's going up and somebody on television recommended it? Or did I actually do some analytical research and understand the fundamental drivers of that company and its positioning in the markets, its market cap? Does it have a moat? Does it provide a dividend yield? What's its payout ratio? What's its history of payouts? All those things. Then you should also have in there, not just how do you come to that decision, is how do you make the purchase of that position? When do you sell that position? What drivers are you looking for to determine my thesis is no longer valid? I need to now sell that position. That should all be in your policy statement. And if you'll do that, just the simple exercise of writing things down will make you a better investor, because it will start to crystallize how you approach the buying and selling of your positions. And again, the buying part is easy. When things are going up, we just buy stuff and they go up and we're all happy, right? The hard part is knowing when and how to sell things. And that's what a good investment policy statement will do for you. So again, these are the things that, we've just learned over time. And, for instance, our investment policy, the what we work with, has been just developed over years and years of hard knocks, right? What we got right, what we got wrong. Oh, that didn't, that rule I thought was a good rule wasn't a good rule at all. That was a terrible rule. Got to change it. But that's how you get there. And so, part of your process, if you sit down and start this process and you think back to all the mistakes you've made over time, write that down. I did this before. I'm not going to do it again. I sold all my stocks to buy all my bonds because, of whatever reason. Don't do that. You should never go from 100% stocks to 100% bonds. Bonds provide a very important ballast to your portfolio. You should own bonds in your portfolio. They provide stability. They lower volatility. They provide a whole lot of benefit. They provide a steady stream of income. A whole lot of reasons to own bonds. But it should never be a 100% bond portfolio, because you need the inflation adjustment from equities over time. Same concept is, I really don't recommend owning 100% equities unless you're young. Now, if you're young, if you're in your 20s and 30s, you don't need bonds. Just buy equities, hold your nose, and just make sure they're good companies. Buy an ETF. You'll be great. But as you're getting older, having 100% in equities becomes way too risky for your capital, because if something breaks, like 2008, and you have an event that comes along that disrupts the economy to a large degree, that devastation can really impact your retirement. So having too much exposed to risk also has its consequences. But again, that's something you have to come to personally. That's your personal decision in your investment policy program about how you manage risk, how do you manage volatility, what is your goal? And one of the most, I'm like right there at the top of your page, right? Your investment policy statement, it should say, my goal is to generate 5% a year, 4% a year, 6%, whatever the number is. And big bold letters. And then don't worry anymore about what the S&P does from one year to the next. Don't worry about what the NASDAQ does from one year to the next. Worry about, did I meet my investment goal for the year? And if you do that, you'll wind up being a much better investor over time. Okay, enough of my soapbox. Get by the website. Make sure you get our tickets for the upcoming investment summit coming up, not this Saturday, but next Saturday. Love to see you there. It's from 8:30 to noon. We're going to feed you lunch, have breakfast, and we spend a lot of time just talking about your personal questions, answering your needs, whatever they are. Love to have you there. Tickets are available right now on the website, realinvestmentadvice.com. Have a great day. See you back here tomorrow with Michael Leibowitz. His article on the website today about why bond yields are rising. We're going to get into that detail tomorrow on the next Real Investment Show. Have a great day.